Hello, everyone, and welcome. We have another great session in store for you today. But before we begin, I'd like to first once again say that our thoughts and prayers are with everyone at this challenging time. We'd also like to extend our gratitude to the many who have been working so hard to keep everyone safe and well, and also to help keep our critical supply chains intact. Our sincere thank you to all of you. By way of introduction, I'm Rodney Sullivan. I'm the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. It is my pleasure to welcome you all here for today's call. For those of you new to this series, the Mayo Center is a center of excellence at Darden with a focus on applied academic research and education. And consistent with that mission, the purpose of this virtual seminar series is to advance the study and practice of asset management through, of course, research and education. I'd also like to take a moment to thank our co-sponsor for this series, the Financial Management Association International. Now, let me share a few housekeeping items with you for today's call before we begin. All participant microphones have been muted and videos are turned off. For those of you having questions for today's speaker, please send them via the Q&A box located at the bottom of your screen, and we'll collect them throughout today's session and put as many of them as we can to our speaker following her prepared remarks. Note that you can download Kelly's slide deck from the Events tab located on the Mayo Center for Asset Management website. In the coming days, we'll also post a recording of today's session on this same site. Okay, with that, let's now move on to today's program. It is my pleasure to introduce our moderator for today's program, Professor Michael Schill. Michael is the Sponsors Professor of Business Administration here at the Darden School of Business. Michael, thank you for being here, and over to you.
Thank you, Rodney. Welcome, everybody. It's great to see so many of us joining us for today's webinar. Our speaker for today is Kelly Hsu, who's professor of finance at the Yale School of Management. Much of Kelly's academic research is on behavioral finance. She's done work on looking at behavioral biases in credit risk assessment, compensation and promotion decisions, merger completion assessment, and election outcomes. And recently, she and her co-author, Richard Townsend, have been looking at something that's very relevant to today's volatile financial markets. That is, they examine a form of bias in stock price reactions to news. Their hypothesis is that because of the tendency for traders to exhibit non-proportional thinking, reactions to news are correlated with something that shouldn't matter at all, the level of a firm's stock price. So if true, their story has a number of important implications for the way we think about security prices and trading. So to discuss this project and other things, we are fortunate to have Kelly Hsu as today's guest. Take it away, Kelly.
All right, well, thank you very much to the organizers for inviting me, and I really appreciate this opportunity to share my research with this audience and also get comments. So let me start by sharing my screen. All right, so today I'm going to present joint research with Richard Townsend, who is at UCSD, and our paper is called Can the Market Multiply and Divide? And we'll show evidence of non-proportional thinking in financial markets. So we begin with this motivational idea that proportional thinking is the right way to go in financial markets. So rational investors should react to news about firm value in terms of proportional price changes, basically returns. So we should think in percents. That's the reason why any asset pricing model is usually written in return units. So let's think about the market value of the equity of the firm. So that's its size. That's by definition equal to the number of shares multiplied by the share price. If we were to hold the firm size constant, the nominal price of a financial security has no real meaning. That price is arbitrarily determined by how many shares that firm is split into, and it can easily be changed through share splits or reverse splits. What's interesting, though, is that changes in the value of stocks in response to news events are frequently reported and discussed in dollar units instead of return units. So here I have a historical example from the Wall Street Journal taken from the 1970s. These were the 10 most active stocks over the previous day. And what's reported here is the dollar change in value relative to the previous day. Okay? You can easily calculate returns by taking this dollar change in value, dividing by the closing share price, but it's not what's emphasized. What's emphasized is the dollar change. And there was such an emphasis on dollar changes in value that the Wall Street Journal used to report a truly useless piece of information. So it would report the average closing price of the 10 most active stocks over the previous day, which was 48.01. And it's not clear what this level is supposed to mean. So this emphasis on dollar changes in value in reaction to news is not just a historical artifact. These are screenshots of modern day smartphone apps. And what they do for their default settings is either to show the dollar change in value or the dollar change plus the percentage change in value. And you would have to go into the settings in order to make the percentage changes more prominent. Same thing for the CNBC ticker. So if we look toward the bottom of the screen, what's emphasized is the dollar change in value for various tickers. Similar problem for discussion of various indices. So people will talk about how the Dow had the largest point drop in history, and that may or may not be a large percentage drop. So our hypothesis then is that the way that the media discusses changes in value may influence and partly reflect the way that investors think. So investors may mistakenly believe that news should correspond to some dollar change in price rather than a percentage change in price. And this could partly operate through memory. So for example, suppose that we get news and there's an arrival of a new talented CEO. So we know it's good news. What we might remember is some other firm a while ago got similar news. That firm went up $1 in value. We might mistakenly reason that this current firm should also go up $1 in value. So the ideal thought experiment would be to consider two otherwise identical stocks, same size, same everything. One is trading at $20 per share and the other is trading at $30 per share. So the $30 per share firm is identical. It's just got a higher share price because it's divided into a fewer number of shares. The mistake would occur if investors think the same piece of news should correspond to a $1 increase in price for both stocks, because that $1 movement would translate into a 5% return for the $20 stock and a 3.3% return for the $30 stock. Okay? So non-proportional thinking as a behavioral mistake predicts that the absolute magnitude of return reactions to the same piece of news will be larger for lower price stocks, all else equal. We can then take this prediction and map it onto various volatility predictions. So let's think about three possible measures of a stock's volatility or risk. So that could be total volatility, idiosyncratic volatility, or market beta, which is how much the stock moves with market returns. What we would predict is that if investors think in dollars for a given piece of news and they react in dollars, that's going to translate into a larger absolute return response and therefore higher volatility for lower price stocks. So these stocks are going to have greater total volatility, idiosyncratic volatility, and market beta all else equal. The market beta component is, suppose the market goes up, we think the stock co-moves positively with the market. If we interpret that in dollar units, it's going to co-move more with the market in return units if it's a lower price stock. So these are a preview of our results. First, we're just going to show you in a descriptive sense. This is not about causation yet, but I just first want to convince you that share price seems to have incredible explanatory power in terms of explaining cross-sectional volatility. So we find that a doubling in share price corresponds to about a 20 to 30% decline in volatility. Further, this is not driven by size. So it is true that share price is correlated with size. So lower price stocks tend to be small cap stocks, and we know that small cap stocks have higher volatility. However, if we can carefully control for size, there's still a very strong relation between price and volatility. And further, we show that the well-known size and volatility relation actually flattens by 80% after controlling for price. So it's really price that drives this well-known relation between size and beta, or size and volatility. Next, to identify a causal effect of price on volatility, we're going to show that volatility jumps up right after pre-announced stock splits. So in this thought experiment, we're not saying that stock splits are random. They're not. They tend to follow good performance, but they are pre-announced. Okay? They're pre-announced by about 1 month, and we think nothing major is changing about a stock on its split execution date. And what we see is a huge jump up in volatility after the split. Why would that happen? Well, the share price is half of what it used to be. And if investors are still reacting to news in similar dollar units as before, the return movements are going to swing wildly, leading to higher volatility. We also find that volatility drops after reverse splits. So in a reverse split, 2 shares become 1. The share price is higher than what it used to be. If we're reacting in dollars, then return magnitudes are squeezed towards 0, and we're going to see lower volatility. We also show that lower price stocks have stronger return responses to news events. And finally, we show that price can explain over and under initial reactions to news, as well as subsequent reversal and drift phenomena. And then throughout this talk, I hope you'll keep a key alternative explanation in mind that we're going to try to deal with. So we are very cognizant of the fact that price is generally not randomly assigned. So low price stocks tend to be small cap, more illiquid stocks that may be more distorted by tick size rounding, and that may directly contribute to volatility. So we're going to consider these alternative explanations quite seriously, but ultimately I don't think they can explain this price volatility relation. Okay. In terms of implications, what we're offering is a new explanation of under and overreaction to news. So this complements other behavioral explanations which have really focused on limited attention. So there it's about some information is public but is maybe buried in footnotes, so that information is not immediately reflected in prices. We're thinking about something different. We're thinking about the news is out there, we all see it, but we interpret it in the wrong units. So that's why the initial return reaction has the wrong magnitude. We're also offering insight into the determinants of volatility and drift. So one key implication I'd like you to take away is I want to call into question this idea that size is a fundamental determinant of volatility and beta and risk. We're going to show that it seems like small cap stocks really have higher volatility because of the correlation between size and price. Okay? If we control for price and vary size, volatility actually doesn't seem to vary that much. Next, we're offering a potential explanation for the leverage effect puzzle. So this is a well-known phenomenon in which past returns are negatively related to volatility. Okay? We have a simple explanation for that, which is if past returns have been negative, that means price levels tend to be lower than what they used to be. If we're reacting in similar dollar units as before, that's going to translate into bigger return swings. That's going to have higher volatility. And I'll also show you some evidence relating to reversals and predictability. I want to give credit to the previous literature. Some of the asset pricing facts I'm presenting today, particularly the leverage effect evidence and what's relating to splits, some of that has been shown in previous work by Black and Olson and Penman. What we're really offering here is a new behavioral explanation of some known asset pricing anomalies. So because we have a particular behavioral hypothesis in mind, we can really start checking for additional predictions and try to rule out alternative explanations. All right, so let me move on to the actual evidence. Our analysis is really quite simple. We're going to consider stock I and year month T. On the left-hand side, we're going to regress some measure of volatility, so total volatility or beta. Regress that on lagged share price as of the end of the previous month, plus some controls. So those controls could be things that we know to be correlated with price, and that may directly affect volatility, such as size, sales or fundamental volatility, volume, bid-ask spread, et cetera. Okay? So non-proportional thinking has a very simple prediction, which is we're going to get a negative coefficient for beta 1, right? Higher price stocks are going to have lower volatility if people think in dollar units. Okay. So here's what we find. In the first column, that shows that a doubling in share price corresponds to about a 30% decline in volatility. Okay. In column 2, this is the standard relation between volatility and size. Okay. So this says larger cap stocks have lower volatility. Okay. And we know price and size are highly correlated. They have a correlation of about 0.65. What's more interesting is when we run this horse race, right? So I'm regressing volatility on lagged price as well as lagged size. And what we see is that the coefficient on lagged price barely changes, and the coefficient on lagged size goes quite close to 0 and becomes insignificant. Okay. In column 4, we want to give size an advantage in explanatory power. So we're going to control for it more flexibly with 20 size categories based upon the Fama-French size category cutoffs in each year month. And still, after controlling very flexibly for size, we see that there's a strong negative relation between lag price and volatility. So that was total volatility. We see a similar negative relation between idiosyncratic volatility and lag price, as well as market beta and lag price. Here's that same relation non-parametrically. On the y-axis is total volatility. On the x-axis are 20 bins in terms of price category. And this is our estimate of volatility within each bin. And the largest category has been normalized to 0. Okay, so what we see is a very strong monotonic negative relation. It's very, we can estimate this with high precision. Each of these vertical bars is actually a 95% confidence interval. And the other thing to notice is it's downward sloping even in the far right-hand area of this figure. So those are the highest priced stocks in our economy. These are the types of stocks that are less likely to be distorted by rounding to the nearest tick. And even among this group, which is less subject to tick size distortions, there's a strong negative relation. Okay, so this is the volatility price relation. Actually, already we're controlling very flexibly for size. I want to show you the opposite result, which is what happens to the size volatility relation after we control for price. So in this top panel, we're plotting volatility against size categories. And we see the standard downward slope that we might expect, which is small cap stocks have higher volatility, larger cap stocks have lower volatility. Okay. In this bottom panel, I'm plotting the same thing, but I'm just adding a single additional control variable, which is lagged share price. And notice this relation flattens by a whole lot. Okay? So it seems like more than 80% of the size volatility relation is actually driven by this correlation between size and price. Okay? And this is not symmetric in that if we go back to the previous figure, this sharp downward slope is after I've already controlled flexibly for size. There's a similar thing going on with the well-known size beta relation. So in the top panel is plotting a stock's estimate of market beta against its size category. Okay? So this is, again, I think a well-known empirical phenomenon, which is small cap stocks co-move more with the market. They have higher beta. Larger cap stocks have lower beta. Okay. I'm again going to shift to the bottom panel, which is plotting that same relation, but I'm just going to introduce one additional control variable, which is lagged share price. Okay. Now you might think, well, beta is measured with a whole lot of noise from micro caps, so that could be true to the far left. But even if we look toward the middle region, toward the right, that beta size relation has really, really flattened. Okay. And I think this is an important thing to note because many of us, I think, believe that size is really a fundamental determinant of risk, that small cap firms are fundamentally more volatile or fundamentally more risky and can move more with the market. What I'm showing you here is if you were to sort within price first and then vary size, you actually would not see much variation in terms of volatility or beta. Moving on, We can also look at the implications for our understanding of the leverage effect puzzle. So this is a puzzle or just an empirically strong fact in the data. What we see is past returns are strongly negatively related to volatility. Okay? There are several potential explanations for this phenomenon, including one explanation that led it to be called the leverage effect, which is that holding the debt level constant, if asset values fall, then the equity becomes more levered and consequently more risky. Because that's one explanation for why risk would rise after negative returns. The problem with this explanation is we see the same empirical pattern for firms that seem to have zero leverage. Okay, so there's nothing to further leverage this equity. Non-proportional thinking offers a different type of explanation. Basically, negative returns imply a decline in the share price, right? If we were to react to that news in nominal units, that's going to lead to higher volatility for lower price stocks. So this is what we see for the leverage effect. So first is, again, there's a very strong negative relation between volatility and share price. There's also, this is the leverage effect in column 2. So volatility is negatively related to past returns. If we run a horse race between share price and past returns, notice the coefficient on lagged share price remains very stable, and the coefficient on past returns is still significant. So there could be something going on with past returns, but it's now got an extra 0 after the decimal point. Okay, so it's much smaller. And in column 4, we're going to control much more flexibly for past returns by controlling separately for each of the past 12 months of past returns. And again, we find a strong coefficient on lagged share price. So overall, what this is telling you is low share price. Why would you be at a low share price? Probably because you had bad returns, right? But it actually doesn't really matter how you got to a low share price, whether you declined toward it or rose toward it or split toward it. Low share price just predicts higher volatility. Okay. In the interest of time, I might skip some of this. But in the paper, we do show that this is not just a small cap phenomenon. Even if we look at S&P 500 firms, there is a strong negative relation between volatility and share price. It's also not just a historical phenomenon. Even if we look at the 2000s or the 2010s, so this is when tick sizes are much smaller, trading frictions are much reduced relative to what they used to be, there's still a very strong negative relation between volatility and share price. Let me now move on to splits as an event study. So in general, I think there is still a concern that there are variables correlated with low share price that could cause high volatility. So maybe it's poor performance and things are just more volatile and noisy during bad times. So to identify a causal effect on price, we're going to conduct a regression discontinuity around stock splits. So following a standard 2-for-1 stock split, the share price falls by half. If people are reacting in similar dollar units as before, we predict that return reactions will be much bigger, leading to higher volatility. So in this thought experiment, we're not assuming that splits are random. They're not random. They tend to follow good firm performance. But what's critical for us is that the splits are pre-scheduled and fundamentals for the firm, such as its size or its investment strategy, they're unlikely to change exactly on the pre-announced split execution date. Okay? We also expect the opposite patterns for reverse splits when share price goes up. So this is what happens around stock splits. On the x-axis, this is event time relative to the pre-announced split execution date. So announcement happens around -20, and then 0 is when the split is actually executed. And what we see is on the split execution date, there's a very large and persistent jump in volatility. This is in event days. We can also zoom out a bit more. This is on the x-axis now is event months. So months relative to the month of the split. And again, there's a little bit of a pre-trend. So we're not claiming that splits are entirely random. Volatility is slowly rising, but there's a very sharp jump up in volatility right after the split. And we can zoom out actually more than 6 months. We can zoom out a year or later. This is a quite persistent jump in volatility. That's a change in total volatility. This is the change in a stock's market beta. As a finance economist, I find this result kind of disturbing because we like to think of beta as a fundamental measure of risk, but it is changing around quite drastically due to splits. This is what happens around a reverse split. In a reverse split, two shares become one. So prices go up and we expect volatility to go down if people are thinking non-proportionally. And indeed, that's exactly what we find. Okay, so a very sharp drop in volatility following reverse splits. This is also kind of the opposite of what you would expect to occur around reverse splits, which is reverse splits tend to happen around bad times. Firms are trying to get you to forget that their share price dropped. So if anything, you would expect fundamentals to continue bad, maybe volatility to keep on increasing, and instead it drops a lot. Okay. There are some remaining alternative explanations. So one of them is this concern that, well, not everything stays constant around a split, right? Why are firms doing splits in the first place? Maybe they want to attract a broader investor base, and that could include these retail or speculative investors who push up volatility through their trading behavior. We can examine this story in a bit more detail. So first is, let's suppose in general, splits are driven by this desire to appeal to a broader investor base. That still wouldn't explain what we see for 2-for-1 versus 3-for-2 splits. Okay? So these are the two most common types of splits in the US economy. In a 2-for-1 split, one share becomes two shares and the price drops by 50%. Okay? In a 3-for-2 split, two shares become three shares and the price drops by only 33%. What we see is that for these two types of splits, they have very similar pre-trends, but the jump up in volatility can be very cleanly sorted by the type of split. So these blue circles show what happens to volatility for the 2-for-1 splits, in which price dropped by 50%, and the red triangles show what happens to volatility in the 3-for-2 splits, in which price dropped by only 33%. Okay, so this tight mapping to how much volatility changes by how much the price changes, I think, more consistent with a non-proportional thinking model. We can also directly look at changes in the retail investor base. Okay, because we actually have plenty of data, we actually do see that the average income of shareholders that hold the stock after a split does change. And there's also a slight jump up in the number of retail investors that hold the stock. But what we also see is that this change is fairly gradual, okay? And it doesn't quite match the large 20 to 30% instantaneous change in volatility that we observe after splits. Okay? So this is not to say that the investor base is completely constant, it's absolutely not. But this change in investor base seems to be much too small to explain this large jump in volatility. Just a brief aside on what's going on in option markets, in case you're curious. So first is, this is on a modern sample of large cap stocks with single traded options. Okay, even for this group of large caps, volatility does indeed jump up after the split. Okay, so that's a solid red line. What's also further interesting is this is implied vol matched over the same period. Okay, so this is implied vol over the next 30 days, actual vol over the next 30 days. So implied vol does go up, but actually doesn't catch up until about 100 trading days later. Okay, so this is consistent with option traders. Maybe they use a backward rolling averages model when they set option prices, but they don't quite fully, they underestimate this increase in volatility. What happens when implied vol is less than actual volatility in a very predictable manner? You can make money, assuming you have low trading costs, by buying straddles. Okay? So you just buy matched put and call options, and if actual volatility is higher than implied volatility, you would make money from your straddle position. So again, I'm not advocating this trading strategy. I don't trade for a living. I don't have a great understanding of transaction costs. But this is a measure of the extent of the mispricing, right? So what we find using a simple straddle position is we can get about a 15% return within 40 days after the split. Okay, and this is not annualized, it's just 15% in 40 days. Okay. Let me skip this and move on to some responsiveness to news. So far we focus on volatility. Non-proportional thinking also predicts that if we can identify actual news events, lower price stocks should exhibit bigger return reactions to that news, all else equal. Okay? The caveat here is we don't know whether stocks over or underreact in any absolute sense. So there could be some other bias that causes investors to underreact in general, but they're just going to underreact to a lesser extent for lower price stocks if they engage in non-proportional thinking. So here's what we can do using text analysis. So this is text analysis of firm-specific news just for S&P 500 firms in the 2000s. So just a reminder, we're not uncovering a small cap phenomenon. This applies to even the largest firms in modern times. So what we see is lagged share price, again, predicts smaller absolute reactions to news. Okay? Similar things for earnings news. So quarterly earnings are probably the most important type of firm-specific news. What's nice about earnings is we know when they're announced. Okay, so they're pre-scheduled. We have a measure of the actual magnitude of this type of news. And again, the lagged share price predicts a lower absolute return reaction to this news, all else equal. Last thing I want to cover has to do with reversals. So non-proportional thinking predicts that if we observe an initial overreaction to news for low price stocks, then eventually, if we do some fundamental analysis or some fundamental valuation, this overreaction should be corrected. Okay. Really important to note, if there is a correction, that does not mean this bias went away. Okay. That just means that we overreacted and then we figured out what the correct reaction to one piece of news was. Next piece of news comes along, we can still overreact to it again if we're thinking in the wrong unit. So we're going to take that classic evidence of long-run reversals from DeBont and Thaler. So they show that past winners underperform and past losers outperform. What we can do is we can replicate DeBont and Thaler in our more modern sample. But more relevant for our paper is we show that the reversal is driven by low price stocks. Okay? And further, that the magnitude of the reversal can be better sorted by price than by size. So it's not just the fact that reversals in any type of drift anomaly is a small cap phenomenon. We're really arguing it's a low price phenomenon after you've already sorted by size. Okay? It's actually more effective to sort by price than by size. In the paper, we show similar results for short run reversal. So this is just to give you an idea of that. So what we see here in the red lines is subsequent performance for the past losers portfolio. Okay, so the past losers outperform. This is standard long run reversal. However, as we move from the most solid line to the more dotted lines, share price is increasing. Okay, and what we notice is as share price increases, the long run reversal gets weaker. So long run reversal is really strongest for the lowest price set of stocks. Similarly for the blue lines, this is the subsequent performance of the past winners portfolio. So past winners underperform, that's just long run reversal. But the long run reversal is really driven by the solid blue line here, which is the bottom price quintile. Okay. And I'll leave you to go through the paper. We really want to show that this is not about size, this is really a price phenomenon. Okay. So let me conclude so that we have plenty of time for questions. In this paper, my co-author Rick and I, we developed this non-proportional thinking hypothesis, which is that investors may think news should correspond to some dollar change in price rather than a percentage change in price. If they think in dollars, that's going to translate into stronger return reactions to news for lower price stocks. The economic magnitudes here are really quite large. So non-proportional thinking can potentially explain a significant portion of the leverage effect puzzle, as well as the volatility size and beta size relations in the data. So this type of result has really caused me to personally question our understanding of whether size is a fundamental determinant of risk. We also offer some insights into the determinants of over and under reaction, volatility, drift, and reversals. And let me end on some possible practical takeaways. And I'll just discuss the top part. So I know that many trading strategies that are being implemented bet on drift or momentum or reversal, so predictable movements in prices. These strategies are known to perform better for small caps. And the downside, though, is that small caps are associated with very high transaction costs and price impact. So one, I think, practical takeaway from our findings is that it might be worth exploring and targeting low-priced stocks for these drift and momentum strategies rather than small cap stocks, because there are indeed a large set of low-priced, mid-cap, fairly liquid stocks that we think this drift phenomenon is actually stronger within that set than the micro or small cap stocks. Okay, and of course, our research should be viewed as a reason to be cautious in terms of considering news in the wrong units. We've identified one particular form, but this list here just gives you an example of all kinds of ways in which financial news is reported and discussed not quite in the right units, and that could lead to mispricing. So I'll end it there, and I'm happy to take questions.
Thank you, Kelly.
Thank you.
Appreciate the provocative presentation here. We've got about 200 participants on the seminar today, and want to invite you to continue to add to the Q&A chat at the bottom of the Q&A box at the bottom of your screen. So one of the big questions that's come out is regarding transaction costs, and I expect you've heard this before. So people are concerned that share price is negatively correlated with transaction costs. And so any additional information you give our viewers to become more comfortable with your finding?
Sure, I think that's a very reasonable, concern. So the worry is lower share price stocks have higher trading frictions, and that's going to translate into higher volatility or just bigger jumps in share price. Okay. What I think goes against that as being a complete explanation of these results is we've done subsample analysis for just S&P 500 firms in the 2000s or the 2010s. And this is a group of much more liquid firms for which, there should be much lower transaction costs. This idea of tick size rounding after decimalization in the 2000s, I think, is less of a concern. And we still find a very negative correlation between share price and volatility.
Are there any additional tests you've done on, other measures of transaction costs, or people are bringing up additional measures, price impact measures, or other maybe nonlinear measures of transaction costs?
We have done it around splits. So if you think back to the options related analysis, so first of all, for option traders to price an implied vol correctly does not require them to trade. Somebody has to generate that mispricing in the first place. I think we haven't tried to estimate variation in price impact costs among S&P 500 stocks, just because we expect that to be so much lower than the other groups of stocks that we thought that would be a clean enough sample by itself.
Okay, another popular question is regarding the shareholder composition. So this question about, do you have a sense of what the proportion is that may be retail investors, and why it is that correct thinking investors aren't attenuating this result?
Okay. Yes, I think so. First, I want to be upfront to the audience. We are alleging a high degree of stupidity here, so I think the bar for our evidence should be high, and that would be appropriate. We have looked at 13F data, so we don't find that institutional ownership changes dramatically after splits. So this much higher volatility is not due to lower institutional ownership after splits. Now, to get to the second part of this question, which is why don't the institutional investors, presumably they're more likely to think in the correct units? Why don't they trade against this? I think what could be happening here is basically a degree of humility, right? So suppose I'm a rational investor and I see a piece of news and I think, oh, this stock should go up maybe 2%. But I see in actuality, it actually went up 3%. Unless I understood the cause of that phenomenon and I have this particular behavioral mistake in mind, I don't think I would automatically trade against that. I would just think that someone else or the market in general has a different, slightly different interpretation of the news relative to what I have. The other reason why I think it's not obvious that institutional investors would trade against this is, let's suppose you've all just seen my paper and you believe it's true, right? The most obvious trading strategy based upon this paper is different bets on volatility or bets on long-run drift, right? I don't think it would occur to us to immediately bet on against daily reactions to news, because that would have the highest transaction cost. So the most obvious arbitrage strategies, let's say you believe this paper and you believe this is the source of mispricing, are volatility bets. And volatility bets don't immediately correct mispricing. They might get rid of that implied vol mistake I showed in options markets, but it wouldn't correct the direct return reaction to the news event itself.
Excellent. That's very helpful. So let's talk about the fundamental, I guess, dysfunction in our thinking. Mm-hmm. And there's some questions on, are you aware of direct evidence, either yours or other evidence, that's underlying this psychology? What's driving the result, and what can we learn about human behavior?
So we are drawing on a large literature in psychology, talking about ways in which people think about, they try to think about value. They're almost there, but they think possibly in the wrong units. So money illusion is a well-documented phenomenon. We should think about real dollars, not nominal dollars. I think there's a quite related problem that's been pointed out in the media all the time, where we get very hung up on the number of points that an index has changed rather than the percentage change. And it's funny, in these news articles, the story always says this actually isn't a large return movement, but the Dow still had the largest point drop in history. So in the same article that tells us to be rational, it's the same article that also makes us focus on kind of the large salient point change. Even when we discuss earnings per share, that's often in the wrong units. So we'll think about some firm had a 2-cent earnings surprise, right? Well, the same 2-cent earnings surprise is a bigger surprise for a $20 firm than for a $30 firm. And I think ultimately we know that we should divide, and academics do, but in our daily speech, we just talk about the 2-cent earnings surprise. Specifically in terms of related laboratory evidence, there's an early paper by Svedsotter and co-authors that we cite. They actually ran a laboratory experiment. So they brought people into the lab, gave them hypothetical firms at different nominal share prices, had them read a fake little news story about what happened to those firms, asked them to predict the new share price. And what the investors predicted was in line with what we would predict if they thought in dollar units. So they didn't think about the share price level of the company. They just thought this news is approximately $2 news or $1 movement news.
So is your hypothesis mostly that we're conditioned to think in this non-proportional way? So that, as an example, I've been focused on United Airlines in the past couple of months, and United Airlines has dropped from $80 a share to $25 a share. And so in my mind, I see this $55 stock price drop. And so my concern, am I going to translate that into future events where I think $55 is a plausible response to equivalent news?
Yeah, I think very much so. So especially if we take the same firm over time, let's suppose United had, let's suppose the same United scandal that occurred several months ago occurred today, right? it should translate into a much smaller, actually, dollar movement. And instead, we might think, well, United has had those publicity nightmares that was associated with a one-day $5 drop. If that same publicity nightmare occurred today, it should also experience a $5 drop, and it shouldn't. It should actually translate to the same percentage drop.
Very interesting. Thank you. Do you have any evidence of this type of behavior in other markets besides equities?
We have thought about looking at it. One area that we haven't explored yet, but we're looking into for a second possible paper, is in exchange rate markets. What we've heard from some traders is exchange rates, they're difficult to talk about because exchange rates are already a ratio, right? So we have dollar Canadian or dollar euro, and those are already reported as ratios. What I've heard from quite sophisticated traders is they talk about movements in exchange rates in terms of bits, so point movements in the exchange rate. But really, we should think about, suppose an exchange rate moved 20 bips, we should take the 20 bips and further divide that by the exchange ratio. Okay, so that requires 2 steps for division. And it's not obvious that people do. Like, so they'll talk about one exchange rate had a bigger bit movement than another, even though it didn't have a larger return movement. The other market that I hope to explore, I'm not sure the extent to which this is true. I've heard from certain Israeli investors that Israel is supposedly just better than other countries, and that most of the news is already discussed and reported in percentage units. If that's true, I would expect this type of empirical phenomenon to be weaker in Israeli markets.
Another question that we received is about the time series effect. You've got that really interesting slide that shows by decade the bias in the volatility estimates. So question is, prices used to trade at around $30 a share, and that has increased more recently. Is a question about the share price level that's seen in the marketplace. What effect might that have as you see time series variation in average share prices?
It's hard to say, and I don't want to claim we can explain the overall changes in volatility. There probably are real fundamental determinants of volatility besides this bias. But I can see a kind of a medium run version of that, particularly in today's markets, which is, markets are down quite a lot this year, right? And much more volatile. So probably the biggest contributor to higher volatility, I don't want to say is this bias, is just literally we're in the middle of a pandemic, there's a lot of uncertainty, so that's going to contribute to volatility. But a secondary contributor to that is if we're still processing the news in similar dollar units as the beginning of the year as we are now, okay, that's going to translate into an added force for higher volatility right now, because we see this news about unemployment, and we think unemployment should move some index this number of points, or should move share prices for individual firms down $10 as though this firm were at the same price level it was at the beginning of the year.
Another hard question for you. Question about what the proportion of volatility that might be explained by the bias you're suggesting. Observe volatility in the market. Do you have any sense of how much of this is your effect and how much might be fundamental volatility?
So I don't think we can say. The reason is I don't know what the correct level of volatility for any stock should be, right? But I do know that it's the same stock before and after the split, and I can see that the investor base hasn't changed that much. So both levels of volatility, and they differ by 30%, can't both be right. So I think something is driven by this bias, but I can't tell you whether the current level of volatility is too high or too low relative to what we would expect in a fully efficient market. Due to other research, probably behavioral biases push volatility too high. There's this other literature that's very compelling about how people trade too much and they add to volatility. But just on this paper alone, we can say volatility shouldn't jump 30% due to price, but we don't know whether it's too high or too low.
Great. Any other practical implications for traders that you might offer up?
So one practical implication, and this partly grows out of my own research interest. Half of my research is actually in behavioral corporate finance. What I find really surprising is that we don't observe more stock splits, given that many CEOs and managers, they own stock options, right? So if these CEOs were to do a stock split, it's an instantaneous, predictable, persistent 30% increase in volatility, which instantaneously increases the Black-Scholes value of their options. So you would think if they understood just this empirical pattern, they don't even have to believe my behavioral story. They just have to know stock splits correspond to higher volatility. We would see these self-interested CEOs do a lot more stock splits. But in fact, we don't observe that. So I think one practical takeaway is from the corporate side, maybe firms should reconsider their motivations for doing or not doing stock splits. Their stated motivation is often that, oh, we want to increase liquidity, or we want to appeal to a broader investor base. And sometimes they actually talk about they want to lower volatility by reaching this broader investor base. And what we see in the data is they accomplish the opposite, which is they get higher volatility. And we also see this funny thing in which after a stock split, investors should double the amount of number of shares traded, right? Instead, what we see is higher number of different investors, but actually the number of shares traded goes down because many investors are failing to double their number of round lots traded, which is, there's no friction saying that they can't do that, but they're failing to do that.
Okay, let's broaden it perspective that you might give for behavioral finance researchers, aspiring researchers in your area, big questions that you think might need to be considered.
Sure. So I've been very, very happy to have worked on behavioral finance. I think it's a way to explore interesting questions in the data. This paper with Rick actually started admittedly as a joke. So we were just joking around because we were frustrated at the way that news could be reported. And we were like, wouldn't it be funny if this were true? And then our first test, it was true. And we basically kept daring each other to say, wouldn't it be funny and ridiculous if this further prediction were true? So we got to the splits and the 3-for-2 versus 2-for-1 splits. So it's been a pleasure to work on this paper, both because, well, we got a research article out of it, and that's our job, but it's, you can test these interesting hypotheses, and some of the more ridiculous ones actually seem to have some merit in the data. In terms of advice, I think since I have moved to Yale, which is very supportive of behavioral finance research, what's changed here is I can pursue kind of more ambitious hypotheses. So I think behavioral finance has somewhat been constrained in that we take Bayesian inference and we allow for a tiny deviation from Bayes' rule. Okay, so everybody is fully rational except for a tiny deviation. And I think that's motivated a lot of research so far. But I do think there are these other biases out there, such as what we're studying, which is just completely wrong way to think about asset prices, completely in the wrong units. And there could be these bigger mistakes out there that are not just tiny deviations from Bayes' rule. And I would encourage people to explore that as well.
Thank you, Kelly. Sadly, we're out of time, but we are grateful for your participation and willingness to share this piece of work and your insights with our audience. So thank you very much. Let me turn the time back over to Rodney.
Thank you, Michael and Kelly, so much for sharing your research and ideas with us. And so with this, our 6th session, we will be concluding this Mayo Center virtual seminar series, at least for now. So on behalf of the Mayo Center and Darden School of Business, we extend our sincere appreciation to everyone for taking time out of your busy lives to join us over the course of these past few weeks. for this Friday seminar series. It is with this series that we've sought to bring you the very best ideas at the intersection of academic research, investment practice, and of course, education. And we hope that you have found these sessions helpful to your daily lives. As a reminder, the presentation and recordings for this and all of our virtual seminar series speakers can be found on the events tab on our Mayo Center for Asset Management website. We also ask that you please be on the lookout for future Zoom events from the Mayo Center in the coming months. So watch this space. I wanted to also extend a heartfelt thank you to the Darden team, ASME and IT, the Mayo Center team, Aaron and Allie, and of course to our faculty, Rich Evans, Mark Lipson, Mary Margaret Frank, Michael Schill, and Pedro Matos. And finally, a big thank you to our co-organizers, the FMA International, for their outstanding and wonderful partnership in this series. So thanks again, everyone. We hope that you all stay well and safe, and that we'll see all of you again soon. This is goodbye for now.